The gentleman from Virginia, our Vice Chair, is recognized.
Thank you, Madam Chair. Welcome. Thank you all again for being here and for helping us sort through this important matter. As I said during the first panel, it seems to me our primary responsibility, or a primary responsibility as we look at this, is obviously trying to figure out how we minimize the impact to the taxpayer and be good stewards of our responsibility that way. And then I think also it's incumbent upon us in Washington to not promote policies that create moral hazard. And obviously I know that's of great interest to you. I have a question maybe for Mr. Ellis, and then maybe Mr. Holden and Ms. Perello and Ms. Jalek might like. I'd like to hear the perspective from your quarter. But my question is what is our goal here, and what is achievable? Are we able to minimize the impact if this bill goes forward? Do you think that this will be effective in minimizing the impact of subsidies to the taxpayer? I mean, we've heard different figures: $1.3 billion of taxpayer built-in subsidy, 1.8, and then that's obviously on top of the $18 billion that the debt that is accrued. And then secondly, will we be, I think, addressing the issue of moral hazard? Will we be encouraging or discouraging, to the maximum extent possible, homeowners from making decisions that not only threaten their property, and that's obviously your concern as members of the insurance industry that are here, the property issue, but obviously, as we see in Japan, it's not just property. It's also lives. And so I was wondering if you could address kind of the big picture, where we're going with this.
Sure.
And how do we measure our success?
And that's always critical, I think, with any government program, is trying to figure out how to measure success, Congressman Hurt. And I think that what we're trying to do, or what we would like to see at Taxpayers for Common Sense, and then also smartersafer.org, is to move this program into a sounder fiscal footing. So to move it to where we're actually, one, that people actually know the risk, and that's part of it, is having accurate and up-to-date flood maps so that they actually know where they're living or buying a home. Second is that they understand the cost of that risk, that they are actually purchasing insurance that's commensurate to the risk, that's actuarially sound, so that they have that tool sort of understanding of where they live, and then also how to mitigate or reduce that risk. And lastly, and very important for our group, is trying to remove that risk off the back of the taxpayer and putting it back onto the rate holders, the policy holders, where it logically belongs. And so I think that we created this program in 1968, and we're stuck with it. And there isn't a private market, large private market anyway, in flood insurance. And so we're going to have to deal with this program and try to move it towards a more actuarially sound basis, and also try to use it as a tool to help people out, not just help them out in buying flood insurance, but help them out of harm's way, to give them those tools and that information to reduce their risk and also reduce the impact on the American taxpayer.
Congressman, I agree with the actuarially sound concept. I won't go into that further. But as somebody who sells the policy to the consumer on a daily basis, I think we actually need to make the program more attractive, because the more people that we get to buy the product, the larger the number is and the bigger the risk pool. And so one of the components of the draft legislation that I feel, as somebody that sells to the consumer every day, is very important, is the loss of use coverage for the residential property, where we could actually have some coverage for them to live elsewhere if there's a flood loss, and the business interruption on the commercial side. Because right now, when you're trying to sell this product to the consumer, there's a lot in the bill, or a lot in the policy, that a lot of coverage that is not there, that I think would make it more attractive. Those components, although we're expanding the policy to some degree, we can make actually sound right off the bat. And I think that the consumer will find it a much more attractive program.
I'm sorry, go ahead.
Thank you, Congressman. There are two things I'd like to address. First, as a representative of the National Association of Mutual Insurance Companies, we believe that the program is necessary. There is not a private market that is available at this time to be able to insure those properties, but it does need to be reformed. It does have significant weaknesses. The first thing I'd like to talk about is the take-up rates. In my testimony, I I testified that less than 30% of people that are in those floodplains actually purchase the insurance. First of all, they may not purchase it. If they do, purchasing a new home, they have a federally backed mortgage, they're required to have flood insurance, they do, and it lapses. There needs to be penalties there to ensure that that doesn't happen. As my colleague here talked about the law of large numbers. That's what the insurance mechanism is, how it's predicated on that basis. We need to have enough people in there that'll pay a little, so we'll be able to spread the risk across a larger base. It'll keep the prices reasonable and affordable. The second thing I'd like to talk about is the idea of the actuarially sound rates, and I will take that up. I think that's an absolute necessity to this program. And there's 2 points I'd like to make about the actuarially sound rates. First of all, the NFIP was formed on the basis in 1968 of gradually moving toward actuarially sound rates for all properties in the program. Here we are 40 years later, and we're not close to that. We need to be able to be disciplined in the program to be able to get to that point, be it 2 years or 5 years. Secondly, these subsidized rates, as they are in effect right now, they apply to all properties, to all property owners, regardless of their ability to pay. If you own a beautiful property and waterfront and you're well established and you can well afford to pay for the cost to insure that property for flood insurance, you are paying the same rate as that individual who has been a property perhaps of lesser means. Maybe they've been there 40 years and they're on a pension. They're paying the same rate. We feel that's fundamentally unfair. So that's why we are proposing the move toward actuarially sound rates should be supported by some type of means-based testing for those folks. Now, again, not through the flood insurance program. If you bury that quote, that subsidy in the flood insurance program, the insurance mechanism, it's hidden to all. It needs to be transparent. So it needs to come outside of the flood insurance program and deal with those individuals who truly need the assistance of government. And the others who don't, who can pay for it themselves and choose to live in those properties, they should absorb the cost themselves.
I would like to comment first on the fact that I don't feel that we are stuck with the National Flood Insurance Program. I think we should all be extremely fortunate that we do have the National Flood Insurance Program. The National Flood Insurance Program has worked in a manner that it was designed to work for. It was designed to protect people for a general condition of flooding. The rates were designed based on an average loss year. Therefore, when you look at a catastrophe like a Katrina, the bill was never designed to fully make the program actuarial sound with an event like a Katrina. The NFIP did not fail during Katrina. The levees broke. The system is not broke. This program, the most important goal here is for this program to continue to protect the 5.6 million people who currently have a flood policy in place. This bill goes a long way towards reducing the federal subsidies and the moral hazard and addressing lingering concerns such as mapping, which is a true concern.
Mr. Hurt, do you mind if I add one more comment to that about the actuarial rates?
Chairman, obviously.
1 minute.
The program doesn't include a factor for catastrophe loss years like 2005, but it should. The reason you have all this federal debt is because it doesn't plan for and it doesn't price for all that. So if you want to send the right signal to the policyholders who live there, but if you also want to protect taxpayers, you really do need to factor in that rate, or as I've suggested on several occasions, the program needs to be purchasing reinsurance as a way to protect against the outlier year. Thank you for the opportunity.
Thank you. The gentleman